Gold and silver are moving higher, but the bigger question is not why prices are rising today. The bigger question is whether this move is simply another short-term rally, or whether the precious metals market is beginning to enter a much more powerful phase. Because something important is changing underneath the surface. Gold is attracting renewed buying interest, while silver is also pushing higher as investors reassess the outlook for interest rates, the US dollar, and global economic conditions. And when gold starts strengthening, while silver begins responding with greater momentum, it is worth paying attention. This is not just about one day's price action. The precious metals market is being influenced by several forces at the same time: monetary policy expectations, treasury yields, currency movements, inflation concerns, geopolitical uncertainty, and the continuing demand for real assets. And there is one question I want to focus on today. Can gold continue leading this move while silver transforms from a follower into the real outperformer? Welcome back to Macro Bullion. I'm Alex James, an independent macro and precious metals analyst, and today we are looking at the latest gold and silver rally from a completely metals-focused perspective. Gold has once again demonstrated why it remains one of the most closely watched assets in the global financial system. When investors become uncertain about economic growth, monetary policy, or financial market stability, gold can attract demand because it does not depend on the earnings of a company, the creditworthiness of a borrower, or the profitability of a particular industry. It is a monetary asset, a reserve asset, and, for many investors, a form of portfolio insurance. But gold is not moving in isolation. Silver is also becoming increasingly important. Silver has a unique position in the commodities market because it combines two identities. It is a precious metal, but it is also an industrial metal dot. Now let's move from the headline rally into the forces that can actually determine whether gold and silver have room to continue higher. The first major factor is the relationship between precious metals and interest rate expectations. Gold and silver do not pay interest. So when investors can earn attractive returns from government bonds, the opportunity cost of holding precious metals becomes higher. But when expectations begin shifting toward lower interest rates, that equation changes. Suddenly, investors have less reason to remain heavily concentrated in yield-producing assets, especially when economic uncertainty is increasing at the same time. This does not mean every rate cut expectation automatically creates a gold or silver rally. Markets are always looking forward. The important question is what investors believe rates will look like several months from now. That is why today's price movement can sometimes appear disconnected from today's economic conditions. Precious metals are often responding to expectations about the future rather than the current headline. And this is exactly why the latest gold and silver move deserves attention. The market is reassessing the monetary environment. If investors become increasingly convinced that the Federal Reserve will have to move toward easier policy, Treasury yields can come under pressure. And when yields decline, the environment can become more supportive for gold. Silver can benefit as well, but its reaction can be more aggressive because of its smaller market and its industrial component. This brings us to the second major factor, the US dollar. The dollar remains one of the most important variables for precious metals. Gold and silver are primarily quoted in dollars, so changes in the currency can influence international purchasing power and commodity demand. A stronger dollar can create headwinds for precious metals. A weaker dollar can remove some of that pressure, but the dollar does not move simply because gold is rising. The relationship works in both directions. If markets believe US interest rates will remain higher than rates in other major economies, the dollar can attract capital. But if the expected interest rate advantage begins shrinking, the dollar can lose some of that support. That is why I would watch the dollar closely during this precious metals rally. If gold continues rising while the dollar remains relatively firm, that can actually demonstrate strong underlying demand for gold. But if the dollar starts weakening at the same time gold and silver rise, the signal becomes even more powerful. It would mean precious metals are receiving support from both investment demand and currency dynamics. Now let's turn to Treasury yields. This is where the macro picture becomes more interesting. A Treasury yield is effectively the market's price for holding U.S. government debt over a particular period. When yields rise, income-producing assets become more attractive relative to non-yielding metals. When yields fall, the relative disadvantage of holding gold and silver can decrease. But we should pay particular attention to real yields. Real yields represent the return on bonds after considering inflation expectations. For gold, this relationship can be extremely important. If real yields decline, gold can become more attractive because investors are receiving less inflation-adjusted compensation from traditional safe assets. And if gold starts responding positively to lower real yields, silver can eventually receive a second wave of attention. This is where the gold to silver transmission mechanism becomes important. Gold often reacts first because institutional investors and central banks treat it as the primary monetary precious metal, Silver can then attract additional demand when investors become more confident that the broader precious metals trend has room to continue. That can create a sequence. Gold strengthens, investor confidence increases, silver begins outperforming, momentum attracts more attention, and then the move can become self-reinforcing for a period of time. But we need to be careful with that final step. Momentum can work in both directions. If the dollar suddenly strengthens, yields rise, and gold loses support, silver can experience a much sharper reversal. That is why I do not see silver simply as a cheaper gold. Silver has its own market structure, it has industrial demand, it has investment demand, it has supply constraints, and it can react much more aggressively to changes in sentiment. That industrial side is especially important right now. Silver is used in electronics, electrical systems, solar technology, and various industrial applications. This means the long-term silver story is not dependent entirely on monetary policy. Even if investors temporarily lose interest in precious metals, industrial consumption can continue supporting the underlying market, and that creates an important distinction between short-term price action and long-term fundamentals. Short-term, silver can be driven heavily by currencies, rates, positioning, and sentiment. Long-term, supply, industrial demand, and investment demand become much more important. This is why a strong silver outlook should ideally contain both monetary and industrial arguments. We want a monetary environment that supports investment demand, and we want an economic environment strong enough to maintain industrial consumption. That combination is much more powerful than either factor alone. Now consider the global inflation picture. Food prices, energy costs, and geopolitical disruptions can create renewed inflation uncertainty. For precious metals, persistent inflation can have two very different effects. If inflation causes central banks to keep rates higher, gold and silver can face pressure through higher real yields and stronger currencies. But if inflation damages confidence in fiat purchasing power while economic growth weakens, demand for real assets can increase. That is why inflation by itself is not enough to predict gold and silver. We need to understand how policymakers respond to it. This is where the Federal Reserve becomes relevant again. The Fed does not control gold or silver prices directly, but its policy decisions influence the entire financial system. Rates influence bonds. Bonds influence the dollar. The dollar influences commodities. And expectations across all of these markets influence investor positioning. That is the chain we need to monitor. If the market begins pricing easier monetary conditions, precious metals can receive support even before the Fed actually changes policy. And that is one of the biggest reasons why gold and silver can move early. Markets are forward-looking. Investors do not wait for confirmation from policymakers if they believe the direction of policy has already changed. They begin positioning beforehand. Now let's look at silver's relative strength signal. Suppose gold rises another few percent while silver rises significantly faster. That would tell us that risk appetite within the precious metals sector is increasing. Investors would no longer be looking only for protection. They would also be looking for leverage to the metal cycle. Silver is often where that leverage appears. But suppose the opposite happens. Gold rises while silver repeatedly fails to hold gains. That would suggest investors remain cautious. They may want the defensive characteristics of gold, but may not yet be comfortable taking the additional volatility associated with silver. That is why I consider silver's relative performance one of the most useful signals right now. The metal itself is important, but its performance relative to gold can tell us something about investor psychology. And psychology can drive short-term markets just as much as fundamentals. There is another major factor: supply. Silver supply does not respond instantly to higher prices. Mining projects require years of investment, permitting, development, and infrastructure. A large portion of silver production also comes as a byproduct of mining other metals. That means silver supply cannot always increase rapidly simply because silver prices rise. If demand accelerates while supply remains relatively inflexible, the market can become increasingly sensitive to even modest changes in consumption. This is one reason why the long-term silver story can remain interesting, even when short-term prices are volatile. But again, timing matters. The market can remain irrational longer than traders expect. Silver can be fundamentally attractive and still experience sharp corrections. That is why we need confirmation from multiple markets. Gold is giving us one signal, silver is giving us another. The dollar gives us a currency signal, treasury yields give us a monetary signal. Industrial demand gives us a fundamental signal. And together, these indicators can tell us whether the current rally has real strength behind it. For now, the key question is becoming clearer. Are we seeing a temporary temporary reaction to changing rate expectations, or are we seeing the beginning of a broader repricing of precious metals? If gold continues holding strength while silver starts outperforming, the second possibility becomes increasingly important. And if that happens while yields decline and the dollar loses momentum, the setup becomes even more constructive. That is where the next major opportunity and the next major risk begins to appear. Now, we get to the part of the precious metals story that I believe matters most for the next move, because gold and silver are no longer reacting to just one economic headline. They are responding to a much larger shift in expectations around money, interest rates, inflation, the dollar, and global risk. And this is exactly where the gold to silver relationship becomes extremely important. Gold is already showing that investors remain interested in owning precious metals, but silver has a different job in this market. It has to convince investors that the economic and monetary environment is supportive enough for them to take on more volatility. That distinction could determine whether silver simply follows gold higher or begins outperforming it. Let's start with gold. Gold's strength is telling us that investors continue to value protection. There are several reasons for that. The first is monetary uncertainty. Markets are constantly trying to determine where interest rates are heading. When expectations change, the value proposition of holding government bonds versus precious metals also changes. The second is economic uncertainty. When investors become less confident about economic growth, gold can attract additional demand because it is not directly dependent on corporate earnings or industrial production. The third is geopolitical uncertainty. Gold has historically benefited from periods when investors are worried about geopolitical stability, currency risks, or broader financial uncertainty. And the fourth is inflation uncertainty. Even when inflation appears to be slowing, investors can remain concerned about the possibility of renewed price pressures. All four of these forces can create a supportive environment for gold. But silver needs another ingredient. It needs confidence that industrial demand will remain strong enough. This is where silver's dual identity becomes critical. Silver is both a precious metal and an industrial commodity. Its applications include electronics, electrical equipment, solar technology, and other industrial uses. That means silver can benefit from long-term technological demand, even when the investment environment is uncertain. But it also means silver can be more sensitive to economic slowdowns than gold. If manufacturing activity weakens dramatically, investors may worry about industrial consumption. If global growth remains reasonably resilient, however, silver can benefit from both sides of the market. Monetary demand can increase while industrial demand remains supportive. That is the ideal environment. And this is why I am watching the current rally carefully. We do not simply need gold to rise. We need to see whether silver can confirm the move. Confirmation would mean silver holds higher levels, attracts stronger volume, and begins outperforming gold over time. That would suggest investors are moving beyond defensive positioning and becoming more confident in the broader metals cycle. Now let's talk about the Fed again, but from a different angle. The important thing is not whether the Federal Reserve cuts rates tomorrow. The important thing is whether the market believes the next meaningful policy shift will eventually be toward easier financial conditions. That expectation alone can move markets. Treasury yields can react before the Fed acts. The dollar can react before the Fed acts. Gold can react before the Fed acts. Silver can react before the Fed acts. This is why precious metals investors should pay attention to rate expectations rather than waiting for the actual policy announcement. If investors begin pricing lower future rates, gold can benefit. If the dollar also weakens, the support becomes stronger. If treasury yields decline and real yields fall, the setup becomes even more constructive. And if silver begins outperforming gold on top of all of that, we could have the ingredients for a much larger precious metals move. But there is a major risk. Markets can become too optimistic. When investors see gold rising, they sometimes assume silver must immediately follow. That is not always the case. Silver can lag gold for extended periods. It can also experience much larger pullbacks. So the correct approach is not to assume that silver will rise because gold is rising. The correct approach is to identify the conditions under which silver has the highest probability of outperforming. And one of those conditions is a stable global industrial economy. Think about the sectors that use silver: solar installations, electronics, electrical systems, advanced manufacturing, data infrastructure, automotive technology. These industries require significant amounts of conductive and highly useful materials. As technological investment expands, the structural demand case for silver can remain powerful, but supply is another part of this equation. Silver production cannot simply increase overnight. New mining projects require capital, exploration, permitting, and years of development. And because silver is often produced alongside other metals, supply is not always perfectly responsive to silver prices. That creates an interesting long-term dynamic. If industrial demand continues rising while supply growth remains constrained, the market can become increasingly sensitive to changes in investment demand. In other words, industrial demand can establish the foundation, while investment demand can determine the intensity of the price move. That is why monetary policy matters so much. If investors suddenly increase their demand for silver at the same time industrial consumption remains strong, the market can become significantly tighter. And that is when silver's higher volatility can work in the bullish direction. But we should also consider the bearish scenario. What if global growth slows sharply? What if manufacturing contracts? What if investors become concerned about recession? In that environment, gold could remain relatively resilient because of its defensive characteristics. Silver could struggle initially because industrial demand becomes a concern. This is the major difference between the two metals. Gold can perform as a defensive asset during economic stress. Silver often needs investors to believe that economic activity will eventually stabilize. That is why the strongest silver environments are usually not simply periods of maximum fear. They are periods when monetary conditions are becoming easier while economic activity remains good enough to support industrial demand. That is the balance. And right now, the market is trying to determine whether we are moving toward that balance. The recent weakness in U.S. employment has increased speculation around monetary policy. But again, the jobs data itself is not the entire story. What matters is how markets translate that information into yields, currencies, and investment positioning. If rate expectations move lower, yields decline, and the dollar weakens, gold can remain supported. If gold remains strong and silver starts accelerating, the bullish case becomes much more compelling. But if inflation concerns push yields higher and the dollar strengthens, the metals could face a more difficult environment. This is why I want to emphasize something that many retail investors overlook. The headline is not the market. The reaction to the headline is the market. If a piece of economic news looks bullish for gold, but gold barely moves, that tells us something. If the same news appears and gold breaks higher while silver moves even faster, that tells us something completely different. Price behavior is information, and relative strength is information. That is why I would rather watch what gold and silver actually do than simply rely on a bullish or bearish headline. There is also a psychological component. When gold reaches important highs, some investors become nervous about buying because they believe they have missed the move. That can create a natural rotation into silver. Silver is often perceived as having more upside potential because of its lower nominal price and higher volatility. But investors should not confuse a lower price per ounce with being fundamentally cheap. Gold and silver have different market structures. The correct comparison is not their nominal price. The correct comparison is their valuation, demand, supply, monetary characteristics, and relative performance. This is where the gold-silver ratio can become useful. If gold continues outperforming silver, the ratio can remain elevated. But if silver begins catching up rapidly, the ratio can fall. A declining gold-silver ratio during a strong precious metals market can indicate increasing confidence in silver. That does not guarantee a rally, but it can provide valuable confirmation. And if we combine that with falling yields and a weaker dollar, the signal becomes even more interesting. So what are we watching now? Gold needs to maintain its strength, silver needs to confirm, treasury yields need to remain supportive. The dollar needs to avoid a sustained breakout higher, and industrial demand needs to remain resilient. If those conditions come together, silver could have a very different risk-reward profile from what investors saw earlier in the cycle. But there is one more piece we need to examine, the inflation question. Because if inflation remains elevated while economic growth slows, central banks could become trapped. And that could create the kind of macro environment where precious metals become increasingly important as investors search for protection against both economic weakness and monetary uncertainty. That is the scenario we need to explore next, because it could determine whether the current gold and silver rally has enough fuel to continue, or whether the market is approaching another period of consolidation. Now, let's focus on the factor that could determine whether this gold and silver rally becomes a much bigger move or simply another temporary advance: inflation. Because precious metals are often described as an inflation hedge, but the reality is more complicated. Gold and silver do not respond to inflation in isolation. They respond to the combination of inflation, interest rates, real yields, currency movements, and investor expectations. And that distinction is extremely important right now. Global food prices are rising, with extreme heat, geopolitical conflicts, and crop disruptions putting pressure on agricultural markets. Higher food costs can eventually affect consumers, businesses, and inflation expectations. At first glance, that should be bearish for gold and silver because higher inflation can encourage central banks to keep interest rates elevated. But there is another side. If inflation remains persistent while economic growth begins weakening, investors can become increasingly concerned about the purchasing power of currencies and the ability of central banks to manage the economy without creating additional instability. That is where gold can become extremely valuable as a portfolio asset. Gold does not need inflation to explode to attract demand. Sometimes uncertainty about future inflation is enough. Investors begin asking whether today's monetary conditions are sustainable. They begin looking at government debt. They begin watching fiscal spending. They begin monitoring currencies. And they start looking for assets that are not directly dependent on the financial system. Gold naturally enters that conversation. Silver can enter it too, but with more volatility. And that volatility is important. When investor confidence in the precious metals trend increases, silver can move dramatically. But when confidence disappears, silver can also fall much faster. So I would not describe silver as simply the safer alternative to gold. It is almost the opposite. Silver can offer greater upside potential in a strong metal cycle, but it also carries greater cyclical risk. That is why the current environment needs to be analyzed through scenarios. The first scenario is what I would call the soft landing metals scenario. In this environment, economic growth slows but does not collapse. Inflation gradually becomes more manageable. The Federal Reserve becomes less restrictive. Treasury yields decline. The dollar loses some momentum. Gold remains strong. And industrial demand for silver stays healthy. This would be an extremely attractive environment for silver. Why? Because silver would receive support from both sides. Monetary conditions would become more favorable, while industrial consumption would remain resilient. This is the combination that could allow silver to outperform gold. The second scenario is the inflation stays hot scenario. Here, economic activity remains relatively stable, but inflation proves stubborn. The Federal Reserve stays cautious. Markets reduce expectations for aggressive easing. Treasury yields remain elevated. The dollar remains relatively strong. In this environment, gold could remain supported by inflation and geopolitical uncertainty, but silver could face more resistance. It might still rise, but the path could be much more volatile. The third scenario is the recession scenario. Economic growth weakens sharply. Manufacturing slows. Consumer spending deteriorates. Industrial demand declines. Silver could initially come under pressure because of its exposure to economic activity. Gold, however, could potentially benefit from safe haven demand. Then, if policymakers eventually respond with aggressive monetary or fiscal support, the environment could shift again. That is an important point. The first stage of a recession is not necessarily the strongest stage for silver. The stronger opportunity can develop when investors begin looking beyond the economic contraction and start pricing the recovery and policy response. This is why timing is so important. Now let's return to the current gold market. Gold's ability to continue rising despite changing economic narratives is a sign that demand remains strong. Investors are not simply waiting for one perfect catalyst. They are responding to a collection of uncertainties: monetary policy, geopolitics, inflation, currency risk, fiscal conditions, economic growth. That combination can create a persistent demand base for gold. Silver, meanwhile, is waiting for stronger confirmation. The market wants to know whether investors are prepared to move further out on the risk curve. If gold continues making progress and silver begins accelerating, that would be a major signal. It would suggest that investors are no longer simply buying protection. They are buying participation in a broader precious metals cycle.